Jamie Wu, welcome to the program.
Thank you.
Now let's start off with looking at the economy. China's economy is expected to grow about 2.1% this year, according to your estimates at Citibank, and 8% in 2021. That's roughly in line with the estimates we're seeing from a lot of global institutions like the IMF, and it is far in excess of what we're seeing for other countries. But what's going to be driving that?
Well, as we can feel in our everyday life, we know the pandemic situation is basically under control in China. So China was basically first in, first out of the pandemic. And also we can see huge stimulus packages in China. So we think those are driving all those economic status coming back. And we think the full impact of the stimulus package is not still yet to come through. So we will still continue support of that in 2021.
And your report mentions a few times this idea of a new economic cycle. I wonder if you could explain to us a bit about what that is.
Well, first of all, this past downturn is caused by the pandemic. So when the virus got contained, we think the economic will recover in a faster way when you compare with past cycles. So that's one of the major features of this new economic cycle. And also I mentioned that there's a lot of stimulus policies all around the world. So the second feature will be, we probably will see lower interest rate for longer term. And third of all, we already see innovations accelerating during this pandemic. And a lot of unstoppable trends, including innovation, digitization, and everything, will probably affect our everyday life.
As the economic fundamentals in China do continue to pick up, as you were talking about, as the economy recovers, does that mean investors should be looking at more cyclical stocks, or how should they be trying to balance things out?
Broadly speaking, CITI is definitely overweighting equity and underweighting debts. While economic recovery, lower interest rate for longer terms, and some sectors are beaten up and they will play catch up in the future. These are all factors that we think equities will probably outperform bonds in the coming years. As you mentioned, the cyclical sector, they are among sectors that has been negatively impacted during this pandemic. And we already observed some of these outperformance of cyclical stocks in global investment markets, and we think they still have rooms to go up.
And the yuan is another factor. It has been on a bit of a tear recently. How is that rally going to affect equities, and will we see more foreign institutional players and even Chinese institutional players getting into the market as a result?
So interest rate differential is one of the major reasons why RMB is appreciating, and we will probably still see that in 2021 because China's interest rate is much higher than some of the developed countries. On the other hand, China is opening up. It's easier to repatriate the investment income. And meanwhile, we see a lot of global indexes, including Chinese assets, including bonds and equities. And those are all factors supporting funds inflows and hence support Chinese investment market. But we also have to be cautious because traditionally, it's not a good news for the export sector. However, we see good data coming from export sectors this November, probably because of the holiday season. Because of the pandemic, a lot of travel expenditures of Western countries might be relocating to gift purchasing, and that's supporting Chinese export demands. That could be temporary. But in 2021, we think, if the RMB appreciates a lot, it may not be a good news for export sector. So investors might need to be cautious about that.
Definitely something to watch. Jamie Wu, thank you so much for joining us.
Thank you.